I don't own gold because I thought it would go to 2,600 or 2,700. I own gold because I'm afraid it'll go to 9,000 or $10,000. While I don't have a price target, I do have a feeling that gold helps me sleep nights and stay calm. And at 71, those are great attributes. In my estimation, gold doesn't go higher, it goes much higher. And in my experience, gold leads. But when the generalist investor adopts the precious metals narrative, which has not happened yet, silver takes over leadership. And when silver takes over leadership, it rises farther and it rises faster.
Good evening and welcome to your economic news update. Today, we're diving into a compelling discussion led by Gregory Mannarino, a well-known figure in the financial world, particularly for his insights into the gold and silver markets. Let's break down the key points. Mannarino begins by emphasizing that silver, in his view, is the most undervalued asset on the planet. He believes that commodities, particularly silver and gold, are severely underpriced when considering the massive global debt burden. Mannarino predicts a significant shift in the market, suggesting that the Dow Jones Industrial Average, Dow, could drop dramatically, possibly reaching a level as low as 8,000 points. This drop, he argues, would lead to a 1-to-1 ratio between the Dow and the price of gold. Such a scenario, he claims, would be triggered by a meltdown in the debt market, a market that Mannarino insists is the real area of concern for investors rather than the stock market, which is often the focal point of mainstream media. The discussion then shifts to the role of silver in the current economic environment. Mannarino underscores silver's potential, pointing out that despite weak industrial production and limited global investor interest, silver prices could soar if global growth strengthens, and the energy transition continues to be a focal point. This aligns with predictions from major financial institutions like JP Morgan, which forecast a significant rise in silver prices by 2025, driven by monetary policy shifts and its value as an inflation hedge.
Don't pay much attention to the top of the Fed, which is highly politicized. I'm in contact with some of the lower-ranked employees of the Fed. Some of them are my subscribers, and I converse with them regularly, and it's been eye-opening. I had a very low opinion of them, and I found out I'm wrong. They're well-meaning and well-informed people. The bias of the employees of the Fed is to keep interest rates high. They see themselves as the only guardian against the destruction of the U.S. dollar by the political class. They don't think, and I think they're right, that the executive or Congress has any interest in controlling spending. And they think that artificially low interest rates will bring about the demise of the dollar faster than it needs to occur. Powell is between a rock and a hard place. The right thing for him to do is to keep interest rates high. The political pressure on him to do otherwise is overwhelming. When he cracks, I don't know, but I think that there's at least a 90% probability that he does crack. If he cracks, then I think past is prologue. And when I say past is prologue, I remember the first part of the decade of the 70s, when inflation in the gold price in the period 1970 to 1971 went up. In 1975, the Fed decided to raise interest rates. When they raised interest rates, the gold price fell by half. It went from $200 an ounce to $100 an ounce. At the end of 1975, they lost their nerve and lowered interest rates. And you had a ramp in the gold price from $100 an ounce to $850 an ounce. If the Fed capitulates, if the political class makes them capitulate, then I'm afraid gold is really truly off to the races. Remember that all-time high is nominal. If you adjust that all-time high for the purchasing power of the dollar, the all-time high is probably closer to $100. I'm afraid I think we're going to see that price. In my estimation, gold doesn't go higher, it goes much higher. And in my experience, gold leads. But when the generalist investor adopts the precious metals narrative, which has not happened yet, silver takes over leadership. And when silver takes over leadership, it rises farther and it rises faster. And the silver equities, with the possible exception of the uranium equities, would seem to be the most volatile natural resource equities of all. Doug Casey observes that the market capitalizations of the high-quality silver juniors, a very small universe, is so small that when the generalist investor comes in the space, there's not enough room in the silo for that money. I remember the early part of the decade of the 90s when we had a spectacular short silver price rally. And we had things like Silver Standard going from 72 cents to $45, Pan American going from 50 cents to $40. You buy these things because you don't know when silver's going to run, and you are willing to subject yourself to breathtaking opportunities, because when they do run, the gains that you enjoy pay an awful lot of rent in a time value of money sense to compensate you for being early. I'm delighted right now to see the hate on social media that the small silver companies are enjoying. I think the problem, and we've described this before, is that investors look at a long-term narrative and they employ a short-term strategy.
Go-to destination for all things
words,
economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
In reflecting on market history, Mannarino notes that despite a bear market in gold since 2011, gold has still outperformed the Dow Jones Industrial Average over the long term, gaining 328% since 2001 compared to the Dow's 79% gain. He argues that the disconnect between the stock market and economic reality, fueled by easy money policies, will eventually lead to dramatic price distortions across various asset classes. As the debt market faces potential collapse, Mannarino expects cash to flow into undervalued assets like gold and silver, driving their prices higher. The conversation also touches on the political landscape, with Mannarino highlighting former President Donald Trump's evolving stance on cryptocurrencies, particularly Bitcoin. He suggests that if Trump were to return to power, it could bolster the cryptocurrency market. However, Mannarino remains steadfast in his belief that silver is the superior investment, even more so than Bitcoin, due to its fundamental undervaluation. Mannarino continues by discussing the broader market dynamics, pointing out that the Federal Reserve's intervention during past market downturns, such as the quantitative easing measures following the 2008 financial crisis, has only temporarily propped up the stock market. He predicts that the next significant market downturn
offered up as the CPI, which you'll recall we describe as the CPI. If you believe in the CPI, it would suggest that inflation is creeping along at 2.6%, above the Fed target, but manageable. The difficulty is that the CPI doesn't correspond to the basket of goods and services that you and I and other consumers live with. The CPI, when it's inconvenient, doesn't measure food or fuel. As you can tell, it's hedonistically adjusted, which means that they arbitrarily assign values to the place I live and the computers I buy. But the most important flaw with it is that it doesn't include the cost of tax and government. For most North American working families, the largest constituent of household expense is tax, generally larger than rent, groceries, and energy combined. A cost of living index that doesn't include the cost of living is a very odd index. The consequence of that is that I believe the deterioration of the purchasing power of the US dollar is compounding at about 7% annually. It's important to consider that cost of living in the context of the yield paid on savings products. Doing that, if you buy the so-called riskless product, the US 10-year Treasury, and get paid 4.25 in a currency that's losing purchasing power at 7.5, rather than making 4.25, you're losing 3.25 in purchasing power annually. And I think that's the circumstance that investors came to see in the middle part of the decade of the 70s, which is why we had an absolute rout in the long bond and an absolute explosion in the gold price. I think that's what's in front of the Fed today. I suspect if the Fed wasn't in place, if you had a deregulated credit market, which is to say, if you had a market in money, a market in credit, that the interest rate would be the real rate of depreciation of the US dollar purchasing power, which is to say 7.5%, plus a premium for risk. If people are concerned about high housing prices, that would certainly fix that. Imagine if a first mortgage was 10%. Imagine if the prime rate of interest was 9%. Imagine if consumer credit was priced at a premium to prime. Will we get there? I don't think so. And I think that investors need to focus on the delta between the yield on savings and the depreciation of the purchasing power.
Turn will be different, as the underlying issues in the debt market will be too severe to paper over with monetary policy alone. This, he argues, will lead to a dramatic shift in asset prices, with gold and silver emerging as the primary beneficiaries. Lastly, Mannarino criticizes the prevailing economic policies, particularly trickle-down economics, which he describes as a scam designed to benefit the wealthy at the expense of the broader population. He warns that both major U.S. political parties are pushing the same flawed economic agenda, which will ultimately exacerbate inequality and economic instability. In conclusion, Mannarino's analysis paints a picture of an impending economic shift, where the traditional stock market may face severe challenges and precious metals like gold and silver could see significant gains. He advises investors to position themselves accordingly, emphasizing the importance of holding tangible assets like silver in an increasingly uncertain economic environment. That's all for tonight's economic update. Stay tuned for more insights and analysis as we continue to navigate these turbulent financial times. Thank you for joining us.